Foreign capital moves like weather patterns these days. You can see the storm fronts forming, but the intensity comes down to how prepared you are for what's heading your way. I'm Mark Roach, and this is FutureWise Energy, an innovative voice, an independent upstream energy platform that's supported by individuals, where I share my views that were developed across cultures, technology, and operating oil and gas fields. In reality, executing M&A, as well as leadership and startups in the industry. I draw from a wide range of personal experiences from over 30 years in this upstream oil and gas industry. Now, 3/4 of all foreign direct investment, FDI, those announced since 2022, have been targeting future shaping industries and energy resources. That's $1.4 trillion in announced projects that could reshape global energy infrastructure. We're not talking about incremental changes here. We're witnessing the architecture of tomorrow's energy landscape being built with today's capital. The numbers tell a story about discipline and disruption. WTI closed at $61.57 per barrel, down 6.3% over the prior week. Brent at $65.14, experiencing similar pressure, but natural gas demonstrated resilience at $3.36 per MMBTU, surging 15.5% this week or last week alone. This divergence reflects something deeper than seasonal demand patterns. It reflects the reality that energy sources are being reassessed and repriced based on their strategic importance rather than just their economic fundamentals. OPEC Plus chose measured restraint, agreeing to increase output by just 137,000 barrels per day starting November. This conservative approach came after tensions between Russia, which favored small increases to support prices, and Saudi Arabia, which pushed for more aggressive hikes to reclaim their market share. The result is acknowledgement of the persistent oversupply concerns, but also recognition that market dynamics are shifting beneath traditional producer strategies. Baker Hughes rig count data reveals a tale of two sectors in the U.S. upstream. Oil-directed drilling continues contracting with 422 active rigs, down about 8% year over year. Gas rig drilling activity shows remarkable strength with 118 active rigs, up about 19% from last October. This increase reflects improved natural gas economics and growing demand from data centers, LNG exports, and industrial applications. The market is telling us something. It's not just about energy, it's about the right kind of energy for tomorrow's economy. The foreign investment patterns confirm this shift. Critical minerals, FDI, is expanding rapidly with Chinese, North American, and European firms focused on copper, lithium, cobalt, and rare earth essentials for batteries and electronics. Announced projects could increase copper output by 10% and lithium by over 30% if they're realized. Geopolitical alignment increasingly drives investment patterns with FDI flows following political relationships more than pure economics. Advanced economies invest more in each other while reducing exposure to China by nearly 70%. Consider the Middle East dynamics. Gaza marine gas fields remain undeveloped despite containing 1 trillion cubic feet of reserves worth billions of dollars. These fields were discovered in 1999 to 2000, 25 years ago, and they could meet Palestinian domestic needs for decades. but they remain constrained by ongoing political conflict and disputes. This represents more than just untapped reserves. It represents the intersection of energy security, geopolitical stability, and economic development that characterizes so much of today's energy landscape. Technology deployment accelerates across our sector. Chevron deployed breakthrough deepwater technology at its Anchor project, successfully operating at 20,000 psi and reaching 34,000 feet below sea level. This industry-first capability unlocks previously inaccessible high-pressure reservoirs in the Gulf of Mexico. Meanwhile, Imperial Oil reports $500 million in cumulative annual value from digital initiatives, with AI-driven solutions expected to deliver over $860 million annually by 2027. The geopolitical element cannot be ignored. Ukrainian drone campaigns have significantly impacted Russian energy infrastructure, taking over 1 million barrels per day of refining capacity offline. Nearly half of Russia's refineries have been targeted, creating fuel shortages and forcing Moscow to import petroleum projects from Belarus. These precision strikes represent perhaps the most reflective sanctions on Russia's war economy, directly targeting revenue streams while disrupting domestic fuel supplies. What we're seeing is capital seeking not just returns, but strategic positioning. Large-scale meta deals, over $1 billion, now represent half the total value of cross-border FDI, up from 1/3 5 years ago. These are concentrated in sectors like data centers, semiconductor fabrication, battery factories, where scale and capital intensity are decisive factors. The upstream consolidation continues. The U.S. energy sector saw $105 billion in upstream M&A in 2024. Though activity has moderated from 2023's record $192 billion, small producers are facing increasing pressure to merge or sell assets as economics favors scale and efficiency. Major operators like ExxonMobil and Chevron expand while independents retreat. This isn't just about market conditions. It's about the fundamental restructuring of how energy assets create value. Foreign investment in energy, well, it isn't following the old playbook. It's following new rules where technology capability, supply chain security, and geopolitical alignment matter as much as resource quality and extraction economics. BP's approval of a $5 billion Gulf of Mexico project expected to produce 80,000 barrels per day by 2030 represents their strategic pivot back to oil and gas development after scaling back renewable energy investments. Tenaz Energy's $244 million acquisition of North Sea gas assets highlights continued appetite for quality gas assets in established basins. The market outlook reflects persistent oversupply concerns as OPEC Plus unwinds production cuts while global demand growth slows. The International Energy Agency warns that supply could outpace demand. Supply could outpace demand by 2.5 million barrels per day in the second half of the year. Natural gas fundamentals remain supportive with robust U.S. production averaging 108.3 billion cubic feet per day in August, up from 107.9 billion cubic feet per day. Political factors remain paramount. Geopolitical tensions, trade policies, and energy security concerns increasingly drive investment and operational decisions across the global energy complex. The old model of purely economic decision-making has given way to a much more complex calculation that includes strategic positioning, supply chain resilience, and political alignment. The foreign investment flows into our sector tell us that capital markets recognize what many companies are still learning. Energy security and economic security are becoming indistinguishable. The countries and companies that understand this shift, that position themselves not just for today's market conditions, but for tomorrow's strategic requirements, will be the ones that capture the value being created by this transformation. Now, this isn't about predictions, it's about preparation. The capital's moving, the technology is advancing, the geopolitical landscape is shifting. The question isn't whether these trends will continue, the question is whether you're positioned to benefit from them. I'm Mark Roach, and this is Future Wise Energy. Keep your wits about you, keep your eyes wide open, and be ready to improvise.